Good morning, traders, or should I say, good morning, option premium time players. What is time premium? Well, the purpose of this program is to explain the options you have in options. And one advantage of writing options or shorting options is the time premium. And the fastest way to tell you about time premium, it's money. Money paid to your account as soon as you make the trade. Write options and get that time premium. Now, as traders, we all know, or we should all know as a trader, that you cannot leave your money in the markets. The markets are a medium for trading, not for investing. You can't leave your money in there 30, 40, 50, 20 years. One has to take their money out, and you do that by trading. Now, there's a simple analogy of putting your money in the market. People say, you put your money in the market, I put my money in the market, you should put your money in the market. Is you are giving your money to the market. And there's three positions, and once you do that, you can buy, or you can short, or you can be in cash. And you have to trade your way through those positions. And cash is a position. Reasoning, because in the marketplace, you give your money to the market. The market doesn't take your money. You give it to the market. So if you giveth, you must tradeth and take it away. Go to the scriptures. And I'm not going religious on you, but the Lord giveth and the Lord taketh away. Well, if you're going to giveth your money to the market, I suggest you trade it and taketh away. Now, trading in a short position, equities or indexes or futures, if you short a position or long the position, buy and hold or short and cover, you only have a 50-50 chance of winning, of making money. The options market is quite different because you have a 2 out of 3 chances, and sometimes I call it 3 out of 3 chances. And what's 3 out of 3? 3 out of 3 simply means you win every trade. That sounds good. So options sound confusing in the beginning, but you're saying that I can win 3 out of 3 chances. I've increased my chances from 50-50. That sounds good. I'm paid immediately, so I'm not giving my money to the market. I'm capturing time premium as soon as I open a position. Well, that's pretty good. But the brochures will tell you that if you purchase the option as opposed to shorting the option or selling it to open, if you purchase the option, your position could increase by 1,000%, I believe is how they word it. Now, if you short the position or sell to open, the position could go against you ad infinitum. In theory, I guess it could. But in theory, a bear could jump through that window, rip your head off. That's theory. Options have options. So before that position can go against you ad infinitum, you would roll away, would be rolling up or rolling down a strike price, or you could roll into another month. You have options with options. You don't have to just sit there and get whacked. And to be good at trading, I think you have to increase your chances better than a 50-50 chance. And you can burn yourself out because in a 50-50 chance, should you sell at 5 cents, 10 cents? What if the position goes against you? What's your next plan? What's your next option? Sell it, lose? Well, options, you have options to make money. And you have a chance to work the trade. This is very important, to work the trade, an opportunity to win, an opportunity to work the trade and find a way to win because you have options with options. Buying at 50-50 chance, buy, sell is just not enough. Now, you have, like I said, 2 out of 3 chances, 3 out of 3 chances with the options. And you do pick your options. Now, there are rules, and we'll cover those in later programs, of when you do buy an option. And when you write an option, you will do it against resistance and with support. You want to pick those positions. Another key thing to remember is that if you're going to just go short naked an option, a put option, make sure it's a position that you want and that you'll take it at that price. Because remember, you can short it and make money. We're going to see some examples here in just a minute. You're going to short, you're going to take this money, and then if it gets putted to you, you get to keep this money, you get the stock at a discount. Now, the time premium, the put, the option contracts are a contract of performance. And the contract lasts until the third Friday of each and every month. So if you did a December call or put right, that December contract will expire the third week of December. If you did November, third week of November, and January, it's going to be the third week of January. So you pick that month as your target month, and your contract's going to last until the third Friday of that month. What contract? Well, if you, for example, were to short a put for $1, you're going to be paid that $1. That $1 goes in your account times the number of shares that you wrote, or contracts times 100. So that money is yours. Now, what you're saying to the market is if that stock does not fall $1 by the third Friday of that option contract, then I'm going to keep this dollar. That's pretty good odds. If the market stays the same or goes against you, you're back to a 50-50 chance. But generally what the market does is the market might stay the same, and this time premium is going to keep shrinking. It's going to keep shrinking. Even on weekends, even on holidays, this is going to get smaller and smaller and smaller until this money becomes yours. And then you don't have to have a stock position now, do you? No, but you just made $1 on time premium as it collapses. So as it collapses, so the position could, a put position would be a long position. So if the stock went up in value, boom, you win. Stock stays the same in value, boom, you win. Stock goes down just a little bit, boom, you win. If the stock falls, okay, I'll take it, but you're going to give that stock to me at $1 discount. That's pretty good. I'll take that position. Then I'm going to run into the call market and do a covered call. And that might be another $1. And that contract's going to say, I'm going to keep this $1 unless this stock goes up by this price. Then you can call it away. Now, I still made the $1. Well, what if the price keeps going on and on and on and up and up and up? Well, you're still going to make money. You won't make as much money as if you were out there just risking your neck on a 50-50 bet. But who cares? We want to be predictable about how much money we can make each and every month in the options market. Predictable income is the name of the game for pros. So the terminology is confusing. We'll talk about a lot of it. You can purchase, or you buy to open, or you sell to open. These are calls and puts, strike prices, the time premium, as I mentioned. But before we go into an example, onto a spreadsheet, let me just tell you one more story. And that has to do, if you're a tennis player or a race car driver, I do both, and you, as a tennis player, if you show up at the local club to play a tennis match, try your best. Do your best. If you win, you win. It's a game. You played it. But as a tennis player, a club player, a non-pro player, if you show up to the US Open or the French Open to play a pro, you're going to get your head ripped off. It's that simple. Because they know how to win. They know how to find a way to win consistently. Now, they can't win every match, the same as on a 50-50 chance of you buying and selling. Some of your losses are going to be greater than your wins. It's not a predictable manner of winning. So sticking your neck out with financial pros that are in the marketplace and you don't have tools in your tool bag that give you an advantage of 2 to 3 chances of winning, then you're in serious doo-doo trouble as far as I am concerned. So now we have examples on a spreadsheet so that we can see how this money is paid to us, how we pay down our positions, how we find a way to make the trade win for us. Because in options, we have options. So stay tuned for part 2.